Hi, I'm Pattu from freefincal. Today let's talk about liquid funds and if these are suitable for long-term goals along with equity mutual funds as part of an asset allocation for the debt component um, in the portfolio. So this kind of sentiment has increased after the Franklin fiasco, where people want to avoid all kinds of risk in debt funds. They want a nice, smooth NAV moving up. And by liquid funds, I'm not literally meaning just liquid funds. I'm talking about funds in the shorter end of the duration spectrum. That is the money market funds, liquid funds, even overnight funds are part of that, and so on. Or those three categories primarily. I don't want to include ultra short term in this because ultra short term can get into credit problems. But in the money market, liquid and overnight categories, it's quite easy to find a fund with reasonable good credit quality. So we are going to take out credit risk more or less from the picture, and we are also taking out visible interest rate risk. That is the NAV moving up or down because of the demand supply fluctuations in the bond market, and we are removing that from our portfolio, that is the debt portfolio, by saying that we are going to use only liquid funds. So it is in that sense I'm using liquid funds in this video. The question then is, so can I use them for long-term goals? The answer is that there are always some kind of risks associated with debt funds, and when you are going to look at gilt funds, what happens is that longer the duration of the gilt fund, the more will be the volatility of the NAV, because of the demand supply fluctuations will be more, because in the bond market you don't want to make the mistake of buying a long-term bond just when the interest rates are going to increase for the fresh bond. So because of that, there will always be speculation. The speculation will become higher in the long-term segment than the short-term segment. Of course, this kind of speculation is also valid for banking and PSU funds, for corporate bond funds, any kind of long-term funds, whether it is gilt or non-gilt. There will always be a NAV volatility because of the demand-supply mismatch. And this is a very visible risk, but invisible risks are more important. Credit risk is very dangerous because it's an invisible risk, because it hits you suddenly, and until the default occurs, you don't actually know most of the time that there is actually a problem in your investment. So that is that's why the unknown risk in any investment is dangerous. Such a kind of unknown risk is also present in liquid funds, is the central message of this video, and that risk is called reinvestment risk, because just like you have seen PPF rates are reset every quarter, and over a 15-year investment period, that is over the period that you hold the instrument, you can see the rates go down, and it has been going down for the last couple of decades, more or less, if you look at it over the long term. And definitely over the next 15 years, you can expect PPF rates to go down, although intermittently there can be periods of them moving up. The same kind of risk, this is called reinvestment risk, that is new interest rate being lower than what you originally held. That kind of reinvestment risk is also present for in the short term, short end of the debt fund spectrum. They are present for liquid funds, money market funds, etc. This is because over the long term, interest rates will go down, and these liquid funds, they will keep rotating their portfolio every few months. Their portfolio will be completely new every few months, and they will be buying newer and newer bonds, and those newer bonds can have lower interest rates, and therefore over a period of 10 years or 15 years, low returns are possible. Lower and lower, progressively lower returns are possible from these liquid funds. That is why it is more risky to say that I don't want any fluctuations in my NAV. I am going to expect 6% from my liquid funds and get lower return. That is more risky than expecting 6% return over the long term from a gilt fund, because you know that the gilts are going to be volatile, and I have already shown in a video that there is a potential for gilt to outperform PPF, and it has consistently done that in the past. But in the case of liquid funds, that danger is always there, that the returns can go down. And this is, of course, returns can go down in the case of gilts as well. But the big advantage of holding a gilt fund is when the interest rates of the when the interest rate drops down, then the existing NAV will go up. That is because the existing bonds are become more valuable, then the NAV becomes high. The advantage of the NAV volatility is that there is a possibility of significant capital gain. Of course, over the long term, that significant capital gain will fluctuate up and down. It can become capital loss and so on. But it has done well in the past, and there is no reason for you to expect a long-term gilt fund to beat a liquid fund over the long term, not over the short term, but over the long term. And therefore, I would recommend that people not completely shy away from all kind of NAV volatility. Yes, credit risk is a problem. Although personally, I feel that a credit risk fund over the long term is not a bad idea, but unless of course these kind of pandemic situations occur, so that's another issue altogether. But if you want to avoid credit risk, I don't see any reason why you should also avoid interest rate risk for long term goals. I'm not talking about anything less than that.